Oh, we're looking at futures that are lower to start the second half. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, vote-a-rama continues. Senators pull an all-nighter on the $3.3 trillion tax bill. And President Trump and Elon Musk are at it again. The commander-in-chief says the Tesla CEO has taken more from government subsidies than any other human in history. And Apple may enlist help from Anthropic or OpenAI to power a new, smarter, more capable version of Siri. The bar is low.
Right. I want to go back to the second thing you said, though, because you take a look at Tesla shares pre-market dropping in a big way after President Trump threatened to withdraw government subsidies from Elon Musk's companies. That's after the Tesla CEO threatened to primary lawmakers who support the president's tax bill. You add it all together, Tesla shares currently down 5.7% pre-market, Matt.
It's all just one big casino. And casino stocks are higher after monthly gaming revenue in Macau exceeded analysts' expectations in June. You can see Las Vegas Sands, Wynn Resorts, and Milco are all rising this morning, especially Milco up 10%, Katie.
All right, let's get back to that tax bill because Senate Republican leaders still scrounging for votes to pass President Trump's $3.3 trillion tax bill. Voting started 24 hours ago, and the president is hopeful.
Hopefully soon. Hopefully today, if we can. Final passage. When I say final is, let's take Senate at a time, okay? But I think Senate should be today, and we go over to the House.
Joining us now is Bloomberg's Washington correspondent Tyler Kendall. Katie's here, obviously, as well. So, Tyler, what have they achieved in the past 24 hours?
Well, that's actually a pretty interesting question because we have achieved a few different things, including that, for example, senators have voted against a key provision that would have allowed states to regulate artificial intelligence. That's something that big tech companies are likely upset about this morning. But when it comes to actually making a crucial movement towards passing the entire reconciliation package, we're really not making much movement at all. Senate Majority Leader John Thune still does not have the votes, and we're still tracking the same 8 key Republican holdouts. And we should say, broadly speaking, most of these Republicans do agree about those core tenets of this package when it comes to the tax cuts, but they seem to be on very opposite sides when it comes to the spending cuts. And there's a few different key threads that we're watching here in Washington, which could inform how we see the rest of the morning develop. One is pressure from the White House. You heard President Trump there. An administration official does tell us that he has been in constant contact calling lawmakers directly about this bill. And they actually have already deployed Vice President J.D. Vance, who's waiting and ready to cast a tiebreaker vote. If it comes to that, he is currently on Capitol Hill talking directly with these lawmakers. And the second is that I would point you to one key amendment that we are still looking out for. This could actually be pivotal to the trajectory that this bill ends up taking. It is an amendment that would have a more lenient timeline for some of those clean energy tax credits that are being phased out when it comes to wind and solar. That might be enough to get a moderate like Senator Lisa Murkowski on board and ultimately this bill over the finish line. I will quickly leave you with, when you asked what they have accomplished, they have actually broken a record, which is the longest ever vote-a-rama with the most amendments. We are currently on amendment number 54, Matt.
All right, Tyler, you have a long night, might have a long day ahead of you. That is Bloomberg's Tyler Kendall. Let's also talk a little bit about Tesla, because the stock is sputtering after that feud between President Trump and Elon Musk reignited on social media. The president posted that the Tesla CEO gets more subsidies than any human being in history. That post came after Musk bashed Trump's spending bill, threatening to unseat any lawmakers who support that bill if it's the last thing he does on this earth. Joining us now with the latest is Bloomberg Tech co-host Ed Ludlow there. So this has been simmering for a while. You think back to the breakup, if you wanted to call it that, about a month ago. It was over these issues.
Yeah, June 4th, 5th and 6th. On the subsidies issue, Bloomberg at the time, that first week of June, calculated, it's not just subsidies, but subsidies, grants, and other incentives were about $25 billion. The New York Times has subsequently said across all of Elon Inc., but it's predominantly Tesla and SpaceX, it's a number nearer to $40 billion. The main sort of point of tension here is that what we used to call the Trump trade in the context of Tesla, that was a boost to the stock prior to the election in November, and at points in the first half of the year where the president's commentary supported the idea that Musk's close alignment to the stock would support its broader objectives, is kind of reversed. The Trump trade is now very difficult for Tesla. But again, you know, it's a little bit of the president said, Musk said. With the point of the big, beautiful bill you just went through with Tyler, Elon Musk has at least been consistent that he's welcomed scrapping incentives for direct-to-consumer incentives for Tesla because he feels that Tesla's lower cost base makes it more competitive against other American car makers.
In terms of this fight, though, it does look like the super genius who started Tesla is being outsmarted by President Trump. He caved in and pulled back his Epstein, which had to be his trump card, right? His Epstein accusations early, although his stock is still worth, $1 trillion.
Yeah, there were essentially three claims from the president this morning outside of the White House, right? The first was he was asked a question by a journalist, would you look at deporting Elon Musk? And the president answered in the affirmative. I would point out that Musk has spoken in interviews over about a 20-year period, but it was also in the 2023 biography by Walter Isaacson that Musk is a U.S. citizen and claimed he took the oath of citizenship in 2002 in Los Angeles County. The president also said he would look at Doge and Doge turning back on Elon Musk and reviewing those federal contracts and subsidies we just discussed. But the kind of core thing here is ideological. Musk has been consistent. He believes that he's worried about the national debt pile and not worried about EV incentives that benefit Tesla. The president says the opposite, that Musk is upset about scrapping direct-to-consumer incentives, and that you will also have seen the headlines from Treasury Secretary Bessent this morning, where he, I'm paraphrasing, but essentially says, Musk is really good at rockets, leave the finances to me. But that is the point of tension that is still there, and as Katie pointed out, has been there for a number of weeks.
Did they actually get into a fist fight? That was, reported, or that was a rumor that I saw on social media. Has your reporting uncovered any truth behind that claim?
Well, my reporting has very clearly reflected that cabinet members had real problems, not just with Musk on an ideological basis, but just operationally within the wings of the White House, in that he had access to the president and advised him on X and XYZ, and then other cabinet members would have a point of difference with the president. What we did report, if you take the case study of Jared Isaacman and his nomination for NASA administrator being pulled, when Elon Musk left Doge, various White House officials, Sergio Gore is one of the ones we named, that were very anti-Elon, basically moved quickly to say Jared Isaacman is a close ally and confidant of Elon Musk, a historic business partner of his. We don't want him to run NASA, so they moved to convince the president, based on his historic Democratic affiliations, that he should pull the nomination. There are other examples about that. I get that in that example, Sergio Gore is not... you guys see the red head? Sorry, we just broke that while we're on air.
Well,
I
tell
just
us
broke the
about
story.
it, Ed.
Yeah, sorry. There's a lot going on this morning. Sources tell us, my colleagues and I, that what has happened in the last 7 days is Musk has gone back into Tesla, and after Omid Afshar was essentially fired, Musk is now overseeing sales. So all of this sales apparatus that had reported into Omid, Elon now has direct oversight. And what sources tell us is the reason that's important is we obviously get sales data this week. Globally, I think it will come in the next couple of days. But Europe's particularly troublesome right now. Elon Musk is now directly overseeing sales responsibility for the United States or North America and Europe. And what I'm also hearing from sources, and my colleagues have reported with me, is that Tom Zhu, who runs the Asia business out of Shanghai, now will oversee global manufacturing operations. So this is kind of idiosyncratic to Tesla and what's going on inside. But it's happening, and the Tesla investors will know these names and try and work out who's steering the ship.
Rearranging the deck chairs, but there's one captain and owner of this yacht. Ed, thanks so much for joining us. Bloomberg Tech co-host Ed Ludlow. He will kick off his program at 11 a.m. Eastern time. Don't miss that. Let's get to another Bloomberg scoop. After the one that Ed has delivered. We got a news on Apple considering using artificial intelligence from a third party, Anthropic or OpenAI, to power a new, potentially capable version of Siri and sidelining its own in-house models. Anurag Rana of Bloomberg Intelligence calls the potential move judicious in wake of Apple's struggles to implement AI in its own operating system. Anurag joins us from Chicago. So I just don't understand, Anurag, why this, $3 trillion company that's made everything we desperately need to live hasn't been able to achieve very much at all with Siri in the past. It's been like 14 years that Siri's been out.
Yeah, I think this is an area. I mean, Siri has the most potential amongst everything that we see on the Apple ecosystem. And they have not been able to deliver it. And, one reason could be that they really don't go and snoop around our personal data. I don't know the reason why they have not been able to deliver, but the fact is they have not been able to deliver. But the news from yesterday is really good because you are getting the latest technology and probably the best technology without spending billions in capex. So I like that. I think it's a good thing for Apple if they're able to pull it off.
Yeah. So as you say, judicious in your reaction piece, is this Apple accepting defeat in some ways? Obviously, they're not giving up on AI. Obviously, they're just looking to go externally. But the narrative that's formed around Apple is that they're behind, that their homegrown efforts haven't been able to cut it and excite investors and excite users of their products. And you could make the case that this is proof that the company sees that as well.
Yeah, and Mark's really reported on this very well. And, we all know the frustration that's happening within Apple as it relates to AI. But, frankly, as a shareholder, if you are a shareholder, would you be worried about this thing? Would you be worried that they're not so great in search and other technologies? At the end of the day, if their ecosystem gets better by a third-party technology and they can do it without paying a lot of money at it, I don't have a problem with it because look at the free cash flow line, look at the capex line. Unlike somebody like an AWS, Meta, or a Microsoft, their capex line has not ballooned up in the same manner, or it's not going to go up at the same manner over the next few years. Why won't shareholders like it, frankly?
Right. And as a user, you won't know and you won't care.
Yeah.
As long as it works seamlessly, you'll be happy and continue to buy
exactly
the products. Although Katie hasn't upgraded her iPhone in also as long as Siri's been alive.
I never will. Yeah, this is pretty much 14 years old. Anurag, really appreciate your insight. That is Anurag Rana of Bloomberg Intelligence. Now, coming up, we'll ask HSBC's Max Kettner why he sees the beginnings of a melt-up in risk assets as a weaker dollar boosts earnings. And then,
later this hour, Fed Chair Jerome Powell joins his global counterparts for a panel in Portugal. We'll bring you their comments live from Sintra. This is Open Interest. Let's get to high interest and look at what's making headlines around the world. Citadel has hired a senior portfolio manager from PIMCO, Avi Tilu, who trades macro relative value, will return to the hedge fund in September. Citadel has also recruited a former currency options executive, David Ossak, from Goldman Sachs. So they're coming for your people. U.S. auto sales surged in the spring as shoppers tried to beat tariff-induced price increases, but sales landed with a thud in June. The annual automotive selling rate likely fell to 15 million from 17.6. It's down now at its slowest pace in 12 months, and we're going to start getting numbers from the individual companies here throughout the morning. Tesla then tomorrow. Michael Saylor's strategy is expected to register an unrealized gain of $14 billion in the second quarter, thanks to a rebound in Bitcoin's price and a recent accounting change. The company's shares have soared over 3,000% since the CEO began buying Bitcoin in 2020 as a hedge against inflation. And this, I think, just furthers the spat, the back and forth, Katie, between Saylor and legendary short seller Jim Chanos.
Yeah, certainly we had fun with that spat a couple weeks ago. I think it'll continue to be a thing. But let's talk broader. Let's talk about this current stock market rally sputtering in 4 weeks. You have flow specialists from Goldman Sachs telling clients, quote, We think this rally will continue for the next couple of weeks, but then lose steam into August, citing historical precedents and seasonality. Meanwhile, HSBC chief multi-asset strategist Max Kettner, he joins us now from our London offices, and he argues that actually this rally looks like the beginning of a melt-up. So, Max, let's talk about that. You have Goldman on one side saying we're going to lose some steam. You say this could turn into a proper melt-up in your notes. What does that mean?
Look, I think when we look at the next couple of weeks, and indeed well into August, I would say, perhaps even into September, really, so really the entirety of Q3, I think one thing that people are underestimating is how strong of a windfall, how strong of a tailwind really the weaker US dollar is and can be for US company earnings. Let's also not forget that company earnings expectations, bottom-up consensus expectations, we're starting from a very, very, very different level compared to where we were 3-4 months ago. Just to give you an indication, 3 months ago, consensus earnings growth for Q2 was about twice as big as it is right now. Right, we came from around $66.50. That is down to $62.50. So right now, in fact, consensus is saying, despite all this front loading that we've seen for much of Q2, despite that bottom-up, earnings are already going to contract quarter on quarter. So that really tells you how perhaps at the beginning of the year, people have been exaggerating a little bit on the US exceptionalism case and the US exceptionalism expectations for growth. But as much as they've done that, they probably have been undercutting expectations a little bit too much in the last 2-3 months. And that bodes really well because we now have the tailwind of a weaker dollar. Plus, we've got very low expectations. And let's face it, when we look particularly at our positioning framework, still nowhere near a sell signal, still very, very light positioning. And that is the proper recipe for a melt-up, I think, in the next 2-3 months.
I mean, I think I heard from Romain Bostic on the close yesterday that we're now more oversold than we have been in a year. And the earnings thing, I think, is fascinating as well. Max, can you expand on that a little bit and put some more numbers behind that? When we came into this year, we were expecting 14% earnings growth, which looked, a little bit frothy. And then I remember, every time I talked to David Kostin at Goldman Sachs, that number got lower and lower and lower. And the last time I think we spoke with him, he said 9%. What's the outlook now?
Yeah, look, when we look at the second quarter, consensus is now saying earnings will be declining sequentially quarter on quarter by 1.5%. Even for tech, if we put the numbers on it, even for tech and the S&P, expectations are flat. And that, to me, is insane, frankly, because you look at, for example, the 7 mega caps. Last year, they've made around 60% of sales from outside of the US. So the weaker dollar really is such a big tailwind. And let's face it, when we look at, for example, at the Q1 reporting season, straight after the Q1 reporting season, we had a couple of weeks of record high buyback announcements. Now, bear in mind, now we've got that extra windfall from a weaker dollar. So I don't think it's outrageous to think that actually now after the reporting season, in the wake of that and then the aftermath of that, perhaps we're going to get even bigger buyback announcements. And all of that, particularly for the US, I think, and particularly for tech, for the mega caps, for the NASDAQ, is a really great outlook.
So do you dive in? I mean, if this is the beginning of a proper melt-up in risk assets, how do you invest around that? What should investors actually do here?
Yeah, so in our asset allocation right now, we've got twice as much EM debt as we've got in our strategic asset allocation. So still very bullish on EM debt, given the weaker dollar. That still really helps, and there's still a great tailwind also for EM rates. Let's face it, you look at EM rates, you're up 12% year to date. A lot of that is EMFX, but a lot of it actually is also from duration and from the yield that's really come through in the last couple of weeks and months. So that's still really bullish. We're almost maximum overweight on high yield credit. Again, perhaps a little bit more dovish expectations coming through in the next couple of days. That at some point will hit a wall, fine, but I don't think we're quite there yet. But, a bit, perhaps a little bit even further spread tightening, though I think particularly on high yield, it's probably mostly a carry trade plus a little bit more dovish rate expectations that have come through now in the last couple of weeks. That really helps. And of course, in equities, to me, just like in fixed income, it's emerging markets, and it's particularly the US. And in the US, I don't think there's any way, you can avoid tech and long tech at the moment.
Can't avoid tech. That's a nice place to leave it. Max, it's always great to see you. That is Max Kettner of HSBC. Meanwhile, let's take a check on futures and on tech ahead of the opening bell. You can see we're down slightly across the indexes right now. The S&P 500 down by about 0.3%. We did hit record highs 2 days in a row, so it's hard to complain too much. You can see the NASDAQ 100, where those big tech names live, down about 0.4%. And the little guys are your biggest losers at the moment. The Russell 2000 down about 0.6%. We'll walk through all the action up next. This is Bloomberg. Welcome back to Open Interest. We're about 5 minutes away from the opening bell here in New York. Here are some movers on our radar. We start, Matt Miller, with Warner Brothers down as Advanced Newhouse plans to sell as much as $1 billion worth of the stock. You can see it's sinking shares almost by 5%.
Yeah, Warner Brothers, so a little block trade going on there. Hyatt is now a strong buy at Raymond James. The analyst upgrading the hotel chain as it plans to sell its Playa real estate portfolio. And I know, because my wife is from Spain, that Playa means beach.
Some on-the-ground reporting there from Matt Miller. We also have Sweetgreen downgraded by TD Cowen this morning to a hold from a buy, with the firm saying that the chain's urban footprint is under extreme pressure. So too are shares this morning.
What does that mean?
I guess that, I don't know, it's expensive.
Its footprint is under pressure?
Yeah.
Those stores are just under pressure?
Under pressure. So are shares. It had an amazing run a couple years ago, but year to date, Sweetgreen is down 53% on a total return basis.
I mean,
You're
my
not
problem
buying
is
enough
that
salad.
every day I buy one,
I see
and it's
you,
like
actually.
draining my bank account.
I know. Maybe
so expensive.
They should factor that into the call as well. You check on futures ahead of the bell. We're down slightly. We'll see if Fed Chair Jerome Powell can turn it around. He joins his global counterparts for a panel in Portugal. We'll bring you there live next.
A castle. We are moments away from the start of trading on the first day of the quarter, of the half, and I feel like kind of the air has been let out of the balloon because there was so much window dressing in the last couple of days, driving us up to all new record highs on the S&P and the NASDAQ. And today, you just really don't need to do that. Like if you bought your stocks yesterday, you can pretty much chill for the rest of the week. S&P futures are down as a result, 0.3%. NASDAQ futures are 0.4%. You can see Ralliant ringing the bell on the New York Stock Exchange. It's been spun off, I believe, from Fortive and JFB, Construction and Development. Look at that, hook 'em horns in the back. Did you see that? That's pretty aggressive for ringing the bell on the NASDAQ. Maybe he's a metalhead. Anyway, in terms of the stocks to watch, it's really all about Tesla and this spat between the President of the United States and the South African CEO of Tesla.
Indeed, which President Trump pointed out. This might explain why you're seeing a little bit of a downdraft at the index level, because this giant company, Tesla, down about 6.7% after the open. That's after President Trump threatened to withdraw government subsidies from Elon Musk's companies. That's after the Tesla CEO ratcheted up his criticism of the president's tax and spending bill. He has been consistent on that point. Tesla shares, again, down almost 7%. I believe you add it together, and now year to date, Tesla shares down almost 30% in 2025, Matt Miller.
Yeah, Tesla, yesterday I double checked, and it was still worth more than $1 trillion. Now it's not. It's no longer in the 4 comma club. Casino stocks are higher after monthly gaming revenue in Macau exceeded analyst expectations. In June, Las Vegas Sands and Wynn Resorts are the two you know, up 6%. Unless you're a casino's analyst or investor, you don't know Melco. But it's a much bigger gainer than the other two. I think a smaller market cap, only a $3.5 billion company. Let's dig into the broader markets as a new quarter gets underway with Bloomberg Markets Live managing editor Christine Aquino. And Christine, this morning on Surveillance, Tom Keene was saying that the kids don't know what window dressing is. Am I that old? Do we not use that term anymore?
I don't think Gen Z uses that term, Matt.
Well,
so...
isn't that what happened in the last couple of days?
Yeah, that's pretty much, it seems like that has been the case, right? But I think there has been some at least news flow driven reason to be buying risky assets, equities and like as well, right? Because we did get more positive noises on the tariffs and trade negotiations front. There has been progress made with several countries, it seems like, though of course there was a moment where it seemed like, for instance, the US and Canada talks were completely off the table, but there were concessions made. And then of course on the tax bill issue, seems like progress being made there as well. And so, you do have an investor base that is a little wary of stocks at this point in time, but they're not necessarily willing to let that go just yet because big risk events coming up, and they're probably banking on a more positive outcome from that.
It's interesting to hear you say that. I was talking to Rick Reeder of BlackRock yesterday on ETF IQ. He said that here he would rather buy stocks than long-dated debt. So we're talking, further out the curve. He still likes the shorter end. But for all the hand-wringing that we do over treasuries, over the 10-year and the 30-year yield, it feels like bonds actually had a pretty good quarter.
Yeah, they have, and if you're looking as well, kind of like their year-to-date performance, they're actually neck and neck with stocks in terms of those returns. And, you can really see kind of the bond market caught between a few factors, right? Like what you're saying, Katie, there is a lot of interest in the short end, particularly because of expectations that, maybe September we'll see the first Federal Reserve rate cut this year, but also further out into 2026, prospects of potentially a more dovish Federal Reserve chair replacing Jerome Powell. We know that conversation is ongoing. We've heard from Scott Bessent saying that they are actively considering potential replacements, and the expectation is that the Fed is going to be leaning more dovish into next year. And so short end makes a lot of sense, especially when we heard from Bessent as well saying that, they're not particularly interested in long end issuance. I think there's going to be a lot of interesting dynamics in the second half for treasuries.
It's funny. We've spoken to Rick Reeder. We speak to him pretty much once a month. He's been very consistent.
Do we have him on Thursday?
We
Thursday
might,
morning?
because Thursday is jobs day in this strange week. But he's been very consistent that he likes the short end, he likes the belly of the curve, and that people really just kind of overthink it. They want to go out to the long end, they want to grab that duration risk, but it's been painful up until the last couple of weeks.
Well, and I have been thinking a lot about this lately because we had Paul Tudor Jones on this program a couple of weeks ago, and he said that if he were Donald Trump, he would appoint the yesest yes man there is. Like basically just a bootlicking sycophant as the Fed chair, right?
Did he say exactly that?
No, but I mean, the idea is someone who will do whatever Donald Trump says. So he only has like the entire Republican Party to pick from. But the question is, does that mean that investors are going to demand a much higher risk premium, especially on the longer end? Because without Fed independence, nothing really matters.
Yeah, well, I mean, I think, Matt, we've seen just kind of a higher risk premium on U.S. assets in general, right? This is why we kind of had this theme of Sell America dominate a lot of the first half, particularly around the time when we did get those Liberation Day tariffs that were eventually postponed. And that's really when investors have started to kind of reconsider, okay, how much do I really need to own in terms of U.S. assets without breaking my benchmarks? And then is there anything else that I can look to beyond the U.S.?
All right. It looks like well, first of all, thank you very much, Christina Aquino.
You
stick with us in case the feed goes down, in case the satellite is knocked out of the sky. Right now, we're going to go to Sintra in Portugal, where the world's top central bankers are gathering together for a discussion with Bloomberg's Francine Lacroix. Let's listen in.
Today, this morning, consumer prices rising some 2% from a year ago, up from May's 1.9%. But then the tariffs still loom large. So how do you see that developing?
Well, first of all, I would note that we are at 2%. And this is the latest reading. This is also the target that we have had, and this is the projection that our staff is indicating for the medium term, which is exactly what we had anticipated. So I'm not saying mission accomplished, but I say target reached, okay? And I think we should start by recognizing that. We faced a massive amount of shocks, compounded shocks occasionally, and we are now through that disinflationary process that we have conducted over the last 2 years. And yes, we are facing a lot of uncertainty. Yes, we are facing the risk of fragmentation increasing. And yes, we are facing geopolitical developments that are worrying generally, but that also are causing two-side risk to inflation. So we have to continue to be extremely vigilant. We have to continue to be committed to delivering on our target. And I think we are at this point in time in a very good position to do that. So we are well equipped to navigate the tormented waters that we should anticipate.
Chair Powell, tariffs are not yet showing up in inflation. Is this forcing you or your staff to actually rethink what the models say about how much the tariffs will ultimately through some of the final prices?
So thank you, Francine. And Christine, thank you to you and your colleagues for putting on another great conference here today. It's been a pleasure. I guess I would start, if I may, by saying that the U.S. economy is in a pretty good position. Inflation has come down close to 2%. We're at 2.3 headline, 2.7 core. The unemployment rate is at 4.2%, so we're healthy overall. If you ignore the tariffs for a second, inflation is behaving pretty much exactly as we have expected and hoped that it would. We haven't seen effects much yet from tariffs, and we didn't expect to by now. We've always said that the timing, amount, and persistence of the inflation would be highly uncertain, and it's certainly improved that. So we're watching. We expect to see over the summer some readings, higher readings, but we're prepared to learn that it can be higher or lower or later or sooner than we'd expected.
But, Chair, would the Fed have cut more by now if it weren't for the tariffs?
So I think that's right. In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
Governor Rhee, South Korea's economy is, of course, highly reliant on trade. Putting aside the deals that each government can strike with the Trump administration, what can central banks, in your position, do to shield economies from the impact of trade tariffs?
Actually, about the tariffs' impact on inflation, our current inflation is well stabilized around 2%, and we believe tariff tends to be deflationary rather than inflationary for three reasons. One is Korea is not likely to use retaliatory tariff. Second, we import 22% of our import from China. And recently, export price of China has been falling at 5% a year for several years, and we believe that it will continue to do so. And at this moment, our growth rate is 0.8%, which is well below our potential growth rate. So aggregate demand pressure is much lower. So our problem is not the inflation itself, but the gross impact of tariff.
So what does that mean you'll do going forward?
Yeah, actually, we have been in an easing cycle, and we cut our interest rate 100 BP from last October. And we will continue to be in an easing cycle given our growth rate. But recently, financial stability risk has been rising, especially housing price in metropolitan area is increasing very fast. So we are keeping an eye on this financial stability risk in deciding the pace and the timing of the further cuts.
Governor Bailey, you've taken the view that the latest rises in inflation in the UK will be transitory. Why are you so confident that inflation will fall back?
Actually, you may have detected I've tried to avoid using the transitory word because it has, oddly enough, it has a bit of a history. But to be serious, obviously any increase in inflation is an increase in inflation, sorry to state the obvious. The reasons it's gone up is really entirely due to so-called administered prices. Now, that's, as I say, that's an increase in prices, don't get me wrong. But it's not telling us much or anything about the context of the economy. In other words, it's not telling us anything really much about the balance of supply and demand in the economy. So I think the key judgment for us is, are we going to get second-round effects from this this pickup? And of course, it's nothing like the pickup of a few years ago, just to be clear. And my judgment is, at the moment, is that the context is different, that we do see evidence. I see some signs of softening in the economy, I see signs of softening in the labour market. We are going to have to see those come through, though. I mean, come through into prices. I think we've still got to see the evidence and prices. But that background context allows certainly me to say, look, I think the direction of interest rates continues to be downwards.
When you look at all of the uncertainty, again, it's a bold call given what happened to oil prices and trade negotiations.
It is. I mean, I would say two things on that. One, I think, as others have said, it's probably, Jay was saying, I think it's a bit too soon, I think, really to see the price effects coming through from the trade and tariffs action. We've made a point of saying also that, I think as Christine was saying, that these are two-sided. They could go either way, could be weaker demand, we could see some supply chain disruption. And the second thing, of course, is that some of these effects, if you take the oil price story, it's gone up, it's come down, all since our last meeting, effectively. So, we always reach for the lexicon at this point. I mean, we've added unpredictability to uncertainty. I was slightly amused at the introductory film this morning with Christine saying all these words, because it's true. Because not only are we getting uncertainty in the sense, the range of outcomes, but unpredictable in the sense that if you get things like, the tariff action, history really isn't a particularly good guide to that, actually. You can't really draw much from the past on that.
Now, Governor Ueda, you're in a slightly different situation, right? Japan CPI has stayed above 2% for 3 years now. What do you see as the fundamental changes in your economy that make inflation more persistent?
So let me say, to put it simply, as you say, headline inflation has been above 2% for almost 3 years, while what we call underlying inflation is still somewhat below 2%. That's the situation we are in. But if I could decompose it further, there's probably about 3 components to it. First, there's underlying inflation dictated by wage price dynamics, whereby increases in prices affect wages, which further affect prices, helped by resilient domestic demand. This component has been going up slowly. But as I said, it's still somewhat below 2%. Then there's going to be perhaps a second component, which will be the expected negative effects of possible tariffs on the economy and on prices. We are expecting this to take place, but we haven't seen that yet. There's a third component, which is a domestic supply shock generated by increases in food prices. Actually, this component accounts for about 50% of the headline inflation we've got at the moment. So netting these 3, we think the first component and the second component will produce a slow increase in underlying inflation toward 2% by end 26 or 27. The third component, food inflation, is going to subside toward the year end. So that we will be closely monitoring interplays between these 3 forces.
But, Governor, how do you view trade concerns the day after President Trump threatened Japan with more tariffs?
Well, it's being negotiated by our minister in charge, so I'm trying to avoid making any specific comments on this.
So let me just ask you, what will be the key trigger for Japan for deciding further rate hikes?
Okay, as I said, it will depend on the relative strength of the 3 inflation dynamics I was describing, and we need some more information to determine that.
President Lagarde, when you look at rate cuts, I mean, are we gonna? Where do you see actually the ECB going? You're in a pretty comfortable position right now, out of all the central banks.
Data will tell. So, I think we are determined to continue to be data dependent, to decide meeting by meeting, and to not commit to any particular rate path. That's the doxa. And we're very lucky because we have just completed our strategy assessment, which really gives us a good framework and good strategy lines within which to operate. But those 3 aspects that I have mentioned, data dependent, meeting by meeting, no commitment to any particular rate path, are constant in that ongoing strategy based on what we have concluded actually yesterday.
Jay Powell?
So from our standpoint, as you will have seen, a solid majority of FOMC participants do expect that it will become appropriate later this year to begin to reduce rates again. And so, that will depend, though, as Christine just mentioned, on the incoming data. We'll be monitoring particularly what does show up in terms of inflation or what does not show up, and also carefully watching the labor market. You know, we watch very carefully for signs of unexpected weakness. We see a gradual cooling, but we don't really see that yet. So those are the things we'll be watching. But as I mentioned, a majority of us do feel that will be appropriate in the remaining 4 meetings of the year to begin to reduce rates again.
Madame Lagarde, the euro has also surged about 12% against the dollar so far this year. Are you concerned that its strength runs counter to your efforts to also loosen financial conditions?
You know, I'm not going to comment on the exchange rate. We take it into account for purposes of our projections. Obviously, it has an impact, but it's a reflection of the market conditions and assessment. It's also a reflection of the strength of our economy. But there has been a clear appreciation relative to the dollar, and depending on how you look at it, it's either a depreciation of the dollar or an appreciation of the euros. And there might be a bit of both in that particular case. We're also looking at the movement, the flow of capitals and the attractiveness of euro-denominated assets, which is also an interesting phenomenon that we've observed lately.
Chair Powell, I mean, is it fair to say, I know, nothing is guaranteed, number one, we all know this. Barring a real surprise, is July just too soon to seriously even consider a rate cut?
Yeah, I really can't say. It's going to depend on the data, and we are going meeting by meeting. I mentioned, how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve.
Governor, what's the biggest risk stemming from protectionist trade policy, actually, for the global economy and for South Korea's?
Can you just...
The biggest risk stemming from trades and protectionist measures?
You know, Korea has a quite export-driven economy. So whatever the global fragmentation has a serious impact, not only direct impacts through the U.S. tariff, but also indirect impacts through China, Mexico, Canada. And we easily can, it really depends on what's going to happen on July 9th. We are actually waiting for the result, but we don't know what's going to happen. But for example, like if the tariff goes back to 26% retaliatory tariff that was announced in April 2nd. And then also with a lot of sectoral tariff which affect our economy, aluminum, steel, and cars, we can easily say that it has an impact larger than close to 1% in our GDP growth rate. And depending on how long it lasts, I think we have to adjust to the new supply chain, so the impact will be larger. So, but I hope that scenario won't come.
What is the most concern for the Bank of Korea? Is it a stalling South Korea exports, slowdown in global trade, or a downturn in the U.S. economy?
It's all linked, right? It's all linked, right? So the global economy slow down. And one thing, I mentioned some negative sides only, but one positive side, I don't know if it's positive or not, but Korean companies has been preparing for the supply diversification long time ago before the tariff, U.S. tariffs started to, because we have some issues with China, and then also Chinese industry has become very competitive. So we had to relocate our, production site from China to elsewhere. So relatively speaking, we are well prepared. And second, still good thing is that we have some strong industries such as semiconductor, which benefit from the AI technology development. So I hope that we can manage it. But on the other hand, given just we look at the sheer size of the export dependence, we will be significantly affected.
Governor Bailey, do you think interest rates will be closer to 3 or 4% at the end of the easing cycle, given all of the inflation and trade dynamics?
That's a subtle way into the R-style question, actually, I would detect. So look, I'm fairly cautious about the whole discussion of the level of R-star and therefore sort of where rates are going to reach in the cycle. There is huge uncertainty around it. What I think is important, and what we spend our time looking at, is how restrictive is policy, both now and going forwards. And our staff do a huge amount of work on that front to judge the restrictiveness of policy in the current context. And how it's how restrictive it's going to be looking forwards if you project forward with the market curves. And the assessment we've got at the moment is that policy remains restrictive. It will continue to be restrictive, although the level of restrictiveness will come down over time, which is what I would expect. So I would expect that level of restrictiveness to come down to a point where it goes more neutral. But I think you have to judge that in context. Just to give you an example of that in the UK economy, the level of household and corporate debt in the UK economy is actually lower than we would have expected it to be, but based on past experience. So again, that feeds through into just how restrictive policy is at a given interest rate. It's somewhat less restrictive probably than it would have been historically.
Could I ask all of you actually thoughts on the neutral rates? Chair Powell.
Thoughts on the neutral rate? I think there are countless empirical and theoretical ways to derive it. At the end of the day, I think I like to look at the economy and ask whether our policy stance is having the effects we expect and want on the economy. And to me, I would say we're somewhere probably modestly restrictive at this level. And by some formulations, we're more restrictive than that. But if you look at the economy, growth has been solid. The labor market is solid and still at historically low levels of unemployment. It's not an economy that feels like it's suffering from very tight monetary policy, but I would say that policy is still restrictive.
President Lagarde?
I would say that it's a nice concept, it's interesting, and many of the terribly talented and brilliant economists in this room actually are delighted with discussion about the neutral rate. But honestly, as we're getting closer to target and to where we should be, or are where we should be, and I don't want to pass judgment on that, I think that discussion becomes less relevant. I think what our staff at the ECB measures leads us to believe that it is higher than where it was before the great financial crisis, but it's relatively low as well, compared, for instance, with what the US neutral rate is at the moment. But it's, in a way, it's a bit of an illusion to discuss that at the moment, because the neutral rate is normally defined in a world where there is no shock, where you have perfect equilibrium. Now, are we in a world with no shocks at the moment? I don't think so. So it's nice to have as a concept, nice to elaborate on it, nice to do research on it, but to use it at the moment where we are as a guiding principle to where we should be, I don't think is particularly appropriate.
Andrew Bailey?
Well, that sort of continues what I was saying earlier. Again, I don't use it as a sort of a guide to where policy should be, but I think this whole concept of restrictiveness is, of course, critical to our judgment, because that's critical to the transmission mechanism of policy, which we have to judge every time we meet. So that's a judgment that, in a sense, we renew every meeting we have. I think I'd rather agree with what Jay was just saying. I think in our case, policy is restrictive at the moment. It's going to become less restrictive based on the curve that we've got in the market. That's what I would expect. We will judge it each time.
Governor Ree? Similar?
I have nothing to add.
Yeah, how would you see it, Governor Ueda?
Yes, so we also estimated something like the neutral rate a number of times. But the range of estimates is very wide. So, but at least we think we can say that the current rate is below neutral. But other than that, I would refer to what Jay said a year or two ago in the Jackson Hole conference, which was like, we are guided by our stars, but under cloudy sky.
President Lagarde, can you talk to us about scenario and why this is, because of the shocks and actually the changes that are going very fast, why scenarios make more sense as a template of the economy?
Oh, okay. So this is a topic that we have largely debated as part of the strategy assessment that we conducted in the last year. And I think, in fairness, the baseline, which is the essential projection on which we work and we determine our monetary policy stance, holds and is decisive in our consideration. But at the same time, our staff has I wouldn't say forever, but as long as I know myself, has always conducted scenario analysis, sensitivity analysis, in order to arrive at the most solid baseline. It is probably the case that we will do more of it, more systematically, that we might publish more often than we have. We have published, I think, in the last few years, in four circumstances we have published scenario analysis. The invasion of Ukraine was one, COVID was one, the oil crisis as well, and the tariff threats. So all those were exogenous factors that were sort of hitting our screens. I think we might do more scenario analysis that will be looking at the longer-term trends that will affect our economy, and that will inform and strengthen our baseline, enhance it probably in its reliability. So that's what we are debating at the moment. How this is built, what assumptions we make, what choices are decided in terms of publishing will be determined by the Governing Council in good intelligence with our staff.
Yeah, and Jay Powell, on scenarios?
So for many years, we have used scenario analysis internally, and I personally find it very useful. I think many of my colleagues do too. You have just many different kinds of scenarios. We have 6 or 7 at every FOMC meeting. They're often the topic of discussion among governors and at the meeting. We have not taken the step of using them as a public communications device, and that's a big difference. So that's one of the things we're going to be talking about this fall. We will wrap up the first part of our framework review, which is the consensus statement, our monetary policy framework, we expect to by the end of the summer. And then we're going to use the fall meetings to look at communications ideas, and that's one of the ones we'll look at. I will say it has a lot of appeal and a lot of questions, and so my expectation is if we're going to do something in that area, it's going to be putting a toe in the water and not just throwing ourselves over Niagara Falls on it. So I can imagine a situation where we would try that in a particular circumstance, but for us, we're just going to do the work and understand it, as many other central banks are doing now.
In our case, we use the scenario analysis in our risk management section as a kind of representing the tail risk. But I have to read the ECB report. But if we have to move that section into the more forecasting section for public communication, I wonder whether it's going to be easy to get some consensus which scenario we have to do it among our probably members in the monetary policy meeting. So because that scenario and the underlying assumption may be much harder to communicate, to agree among the members. And also, it's specific to us, but how I can differentiate the previous approach of risk management section to the focusing that I have to think over what we have to do.
So I think 2 things I would add, and it's very much in the same spirit as colleagues. One, we introduced 2 scenarios in the May round and in the May report. For me, they were very useful. They were either on either side. They weren't symmetric, by the way, but they were on either side. For me, they were very useful in terms of my decision-making because they helped me to answer the question, given the uncertainty. If I'm wrong in my judgment, how wrong am I going to be? Do I think I'm going to be? And what would be the consequences of that? And what would we then have to do to deal with them? And is it manageable? And that was helpful. And then I think the question, coming back to what Jay was saying in terms of public communication, I mean, this is the big step, I think, and it is challenging. I'll tell you why, because I say this quite a lot. We make a lot of conditional statements. You may have detected this in all the many interviews you do. And I'm not making a personal comment now, Francine, but a lot of those conditional comments get immediately translated as unconditional comments. It's sort of life.
We're quite careful, but
no, it's not personal. This is the general point. And so the reason I say this is that if we, and that's about the central case, by the way. So if we introduce scenarios, that's a message to us that you're going to have to do this very carefully in that world, because to get the point across about there is always a range, there is always uncertainty, there is always risk. How you calibrate those and how you, as Jay was saying, how you communicate those publicly is critical, but pretty challenging, frankly, in that environment.
Governor Ueda?
Yes, we also carry out many simulation exercises about scenarios, but we have not, as far as I know, published them. We do discuss in our quarterly reports qualitatively what risks we have in mind. Mm-hmm. On top of that, I would say, in a very rough way, we are carrying out something like a risk management approach to monetary policy making, which is probably a bit similar to what Christine was talking about yesterday. I can't come up with a good example, but risk scenarios, thinkings about tail risks, sometimes do affect our monetary policy making.
Can I ask you all about the dollar, everyone's favorite subject? So when you tune out noise, right, of the past few months, what has really changed about the dollar? Governor, are we really seeing some sort of paradigm shift in the status as a reserve currency that means historians will look back on 2025 as some sort of pivotal year?
I don't think so, especially in case of Korea. Our Korean won has appreciated significantly in the last 2 months. But I think it's mostly due to the very unique situation that we had. We had a very unexpected, unnecessary martial law declaration in last December. And after that, this political risk, together with the slowdown of our economy, really make a Korean won depreciate much more than our fundamentals explain. So in some sense, the appreciation that we have observed in the last 2 months, in some sense, normalization of our currencies. And as for the kind of long-term shift of the dollar sentiment, we have discussions, but looks like people are talking about it. But at this moment, they keep the dollar assets while they're increasing the hedge ratios. So at this moment, I think the lion's share of the impact, BIS report show this one, is impact is mostly moving from the unhedged to the hedged positions. So we have to see what will happen in the future.
Yeah, Governor Bailey?
Well, I'd say two things. First of all, I think that it's important to bear in mind what the definition of a reserve currency is and how it's evolved over many years. So I like Chan Ray. I don't see there being a major shift at the moment. Not least because in this day and age, the definition of a reserve currency has as much to do with the supply of safe assets into the market that can be used for all the purposes of collateral and security that they are, as much as it is about a pure exchange rate. So I think we're a long way off that change happening. The second thing is going back to something Christine was saying earlier. I mean, when we look at financial conditions, which we do, of course, but I do think particularly, I always believe this, but I think it's even more relevant at the moment to unpack a financial conditions index. And the reason I say that is because we've seen a breakdown in the correlations of the components of a financial conditions index. So you look at bond yields, you look at exchange rates, you look at equity risk premium, for instance. Those correlations are not the ones that we've tended to see established over time. So you have to look at it much more carefully. There are stories, to my mind, about each of the components of that. So when I look at the exchange rate, I look at it very much on that basis. I don't think it's sensible to pack it all up as we normally would and say it's all behaving normally, because the correlations are not actually.
Governor Ueda, there's also many colleagues at central banks, I guess, around the world are building up gold reserves. Is that the only real alternative to the dollar?
I think it's up to a certain extent what areas like Europe or China would do in terms of improving the efficiency or convenience of their currencies, like the kinds of things we were discussing this morning, capital markets integration, and these things will change the degree to which the role of the dollar may decline in the future.
Women Lagarde?
I think, I don't know if 2025 will be a pivotal year. I would tend to think that, yes, it might very well be. But for a major change to occur will take a lot of time and will require a lot of effort. And I completely agree with the points made by Andrew about the dichotomy that we're seeing at the moment. And that might be an indication of the fact that investors are looking at options. This is what investors are saying. They ask questions. They seek alternatives, and whether that translates into a general lack of confidence that will be further fueled by more uncertainty, more unpredictability, a bit of a jump in the unknown on several fronts, not just monetary policy, not just even the economics, but beyond that, in terms of security at large, for instance, I think remains to be seen. It's not going to happen just like that overnight. It never did historically. There is no reason it should now, but there is clearly something that has been broken, and whether it is fixable or whether it is going to continue to be broken, I think the jury is out on that front.
And Chair Powell, how do you think we'll look back on 2025?
So you're asking me how we're going to look back on 2025?
Yeah, how will historians look back on this year? Okay. Is it pivotal?
It's clearly an important year. There's a lot going on, with trade, and I'm hopeful that we'll look back on it as a year where we successfully challenged some significant economic changes, and our job is to make sure that is the case.
You get attacked by the president a lot on a personal basis. Does it make your job harder?
I'm very focused on just doing my job. I mean, there are things the things that matter are using our tools to achieve the goals that Congress has given us: maximum employment, price stability, financial stability, and that's what we focus on, 100%.
Madame Lagarde, if you were in the same position as Chair Powell, would you do anything differently?
I think I speak for myself, but I speak for all colleagues on the panel. I think we would do exactly the same thing as our colleague Jay Powell does. The same thing. Yeah. Right?
Yes.
Governor Bailey, is the rest of the world decoupling from America but pulling tighter elsewhere? How do you see fragmentation happening?
Well, fragmentation, were it to happen, in my view, is bad for activity in the world economy. No question about that. I mean, if we reduce the openness of the world economy, that will be bad for activity in the world economy. Now, I temper that in one respect, because obviously we have learned a lot about the robustness of supply chains over the last 5 years, and it is, of course, appropriate that there will be adjustments to that. But if we see a breakdown of the openness of the world economy sort of beyond that sort of resilience that we do see as needed, then that's bad for activity, it's bad for the world economy, and that I'm afraid is something that I think we need to be very clear. I've said a number of times, look, there are reasons why this is happening. It's not right to just go around saying this is all wrong. There are no reasons why this is happening. What I think is very important is that we get back to a governance of the world economy where we can address these issues in the appropriate multilateral fora, and get to the question of what lies behind these issues, what's at the root of these issues, what exactly are the issues, and what do we do about them. And I can't emphasize this enough, that I think it's an obligation for all of us who are obviously very heavily involved in the governance of the world economy. We've all got very big responsibilities, to say that is our duty, to get back and to the process of saying, what's caused this and what do we do about it, and what do we deduce are the underlying issues and how do we address them? Because otherwise, say fragmenting the world economy is a bad outcome.
But what kind of fragmentation would it be? Is it, again, are you fearful that the world is splintering irrevocably, or is there a pool that's just moving?
Well, I think if it was a breakdown of trade in the world economy, obviously exactly how that would manifest itself would remain to be seen. But it would be running against a long period now where we've been building the resilience of trade in the world economy. We've been building openness. But as I said, I want to sort of temper that by saying, look, there are issues. I don't think we should say there are no issues. This is all made up. There are issues, and we need to address what they are and work them out. But we need to do that in the context of a commitment to a robust, open world economy.
Governor Rhee, as the only governor here representing a non-reserve currency country, how concerned are you about fragmentation of the global financial system and the risk at the end of the day that the US may be less willing to provide dollar liquidity in a future financial shock?
No. But I think I mentioned that we are quite vulnerable to the fragmentation. But in reality, as a small country, it's a pity that we can raise our voice, but in reality, we cannot change the course. So we have to probably take it as an environment and to adapt to it. What matters is we talk about economic fragmentation, but for a country like us, the most serious issue is combined with security. And for that issue, let me stop here because I don't want to go further. But as for the dollar liquidity support, as demonstrated during the global financial crisis and pandemic period, the standing dollar swap lines with 5 international financial centers and the 9 ad hoc temporary swap lines for the 9 non-reserve currencies, that was crucial in restoring the stability in the global world. And if another global dollar shortage hits, I believe that the U.S. Fed will extend their swap lines again, which is very important. And but one other problem for a country like us is we know that the U.S. provide ad hoc swap lines as long as there is a global dollar shortage. But issue is what happens if there is our own problem and there is no global dollar shortage. Our understanding is that Fed cannot extend the swap lines in that case, and we have to self-defense ourselves. That is why I think having a adequate, sufficient level of reserves is very important. And recently, thanks to the introduction of the FEMA repo facility by the Fed, actually these reserves become much more effective tool to defend ourselves.
Jay Powell, on fragmentation?
Well, I guess I'll just agree with what Chang Yang said, which is, or point out that nothing has changed relative to our swap lines. We still have the same authorities, and we're still prepared to use them in situations where it's within our legal authorities and where we think it makes sense. So that is, we're aware that that's a big contribution that we can and do and will continue to make to global financial stability.
Governor Ueda, how much do you think about fragmentation and the impact this could have on Japan?
See, on the trade side, I think a lot about what will happen to Asia, even Asia excluding China. So this will depend on the relative tariff rates imposed on the region relative to China or relative to other countries. But there's a fairly strong intra-regional trade taking place during the last decade or two. Also, there's new countries like India growing at very high speed. So I hope there's a sufficiently resilient domestic demand in the region to keep the energy of the region alive. On the financial side, I don't have much to add to what other people have said, but it would be important to keep trying a multi-layered approach to things like swap lines. We have Chiang initiatives in Asia. Doing something similar or continuing to do something similar would be important.
Madam Lagarde, you've often spoken about the role that Europe could take in a fragmented world. How do you see that developing in what kind of time frame?
Well, I think Europe has witnessed in the last 4 years, in particular, well, since 2022 in particular, the last 3 years, major challenges to its way of doing business, to the assumptions that it has made about security, about supply, about destination. Whether you look at what the horrible Russian invasion of Ukraine has precipitated and how that has impaired the sentiment of security that we in Europe had, and the sentiment that we could, forever rely on the protection of others, that has been impaired significantly. When you look at the energy supply on which some of the European countries in particular, but most of us, have relied upon, namely access to reasonably cheap oil and gas supply from Russia, that has been impaired significantly, and we had to find the resources to respond to that. And whether you look at the business model of some countries where destination was inevitably China in the main, that has already been challenged as a result of the fragmentation that is not just a risk, but which has happened. If you combine that with the technology risk that we could all be under, either because of political determination or because of shortage of supply, whether it's on the front of microchips or rare earth, I think we are in a situation where many of the assumptions have been shaken up and where we collectively are on the cusp of, I hope, this is my hope, of better taking hold and control of our destiny by making significant structural efforts to be more independent, be more productive, be more autonomous in all these different dimensions. Is it going to happen overnight? Yet again, no, because on some of those fronts it takes time, it takes investment, it takes political determination, it takes momentum. And from a pure sort of, as president of the ECB, what we can do on the monetary front is to deliver on our mandate of providing price stability so that the fluidity of factors that is needed, both in terms of capital, in terms of labor, can rest assured that price stability will be within our remit under strict commitment to deliver on our target of 2% medium term. But yes, I think it's a historically, I believe that in a few years' time we will look at 25 of those latest 3 years as significant change in the way in which we conduct our life, our business, and develop Europe. And I hope for the better.
Jay Powell, last year in Sintra, you said that the U.S. cannot run these kind of deficits in good economic times for very long. And then you also said we'll have to do better sooner, something sooner or later, and sooner will be better than later. How's it going?
So, of course, I probably preface that by saying that we don't comment on fiscal policy. That is the one thing that I have said, and my predecessors have also said, and that is the U.S. federal fiscal path is not a sustainable one. The level of the debt is sustainable, but the path is not, and we need to address that sooner or later. Sooner is better than later. That's what I said last year. There's not a lot more I can say.
For everyone else, how much of a problem for the world are America's public finances?
That was Bloomberg's Francine Lacroix moderating a panel in Sintra, Portugal, with obviously Fed Chair Jerome Powell, as well as his global counterparts. You can continue to watch this panel on your Bloomberg terminal. Just type LIVE GO on the Bloomberg. I want to bring you some headlines that we're getting from the Senate, specifically from the Senate leader Thune, saying that he believes the GOP has a deal to pass for President Trump's one big, beautiful bill. We also got an alert from Senator Hoeven that the Senate is near a final vote on this tax bill. So it looks like they have rounded up, I guess, at least 5 of their holdouts. There were 8, and they could only afford to lose 3, as far as I understand it. Let's get to someone who knows a lot better than I do, and that is our Washington correspondent Tyler Kendall. So, Tyler, what do we know about Susan Collins, about Lisa Murkowski, about Joni Ernst? You know, some of these holdouts that were worried about the Medicaid cuts.
You're exactly right, Matt. And actually, I'm on the same page as you, because at the moment we have not gotten further details beyond that. We did see that the whip put out a notice that they are expecting senators to convene on the floor in the next 10 minutes or so. They're setting up for about a 10:30 a.m. Eastern vote series. And this is going to be the final vote series. And just to sort of get our bearings here, they're not going to immediately vote on final passage. We're probably going to see some procedural votes first, as well as some other amendments that have still been outstanding. But once they are done with that, then we could see the vote on final passage. And Senate Majority Leader John Thune told reporters earlier he does think that he has the amount of votes needed. But he also added, quote, "I've always been a realist, so we'll see what happens." You had mentioned it at the top there. The exact math that he needs is 50 Republicans on board with this, because he already has Vice President J.D. Vance there on Capitol Hill waiting to cast that tiebreaker vote. And it does appear, according to some of the senators on the Hill, that they are going to need to deploy him to get get this bill over the finish line. We are still waiting closely. We know that he has been huddling the majority leader with Senator Lisa Murkowski, for example. She was somebody actually that President Trump earlier today was asked about specifically. So we're waiting to see if there's additional details here when it does come to some of those changes to Medicaid. And I would also point you to watch to see if we get any shifting in language around the phase out of those clean energy tax credits, particularly when it comes to wind and solar. We know that that has been a top priority for the members that you're discussing there.
And we just got this headline in the past minute or so that the senators were called to the Senate floor as that tax bill nears the final vote. So, Tyler, let's talk about where it goes from here. Going back to the House, how do the bill's odds stand there?
Well, they're definitely getting a little concerned about what it is going to look like when it does get over to the House, because we've heard from House Speaker Mike Johnson urging senators to not change the language too much because they're already starting to get a little bit of upset with how this bill is shaking out, particularly in the fact that it falls about $500 billion short when it comes to promised spending cuts. The thing is, the spending cuts really are what's dividing the party when it comes to the Senate, as you see these more moderate Republicans holding out because of the changes to Medicaid. So this really could potentially be an issue going forward. We can say that some in the House have already said that they have made their compromises, such as the SALT caucus, for example. They seem to be getting on board with that $40,000 cap under a 5-year limit instead of the originally proposed 10-year limit. But there could be a little bit more of an uphill battle when they do kick this over to the chamber. But keep in mind that it has been designed not to ping pong between the chamber. That means that we're going to get something known as a wraparound amendment. We won't get too wonky, but essentially that's supposed to try to iron out some of the details in the language differences between the two chambers in a bid to try to smooth passage so that this doesn't get stalled, since the White House has made clear they still want to see this on President Trump's desk by this Friday.
We know that before it can get to the House, and we know that Nick LaLota, for example, is against the changes in SALT, although he is willing to accept some kind of cap, which I think is pretty interesting in itself. Before it gets there, Rand Paul is not going to vote for this. Thom Tillis is essentially going to quit because he thinks the legislation is so bad. What does that mean? Does that mean they can't afford to lose 2 more senators?
Right, exactly. There can only be one other that can't vote for it, because we know that those are 2 likely no's. Thom Tillis for a few different reasons. One, the proposed cuts to Medicaid, as well as those clean energy tax credits. And as you mentioned, he gave us a surprise announcement over the weekend saying that he's not going to run for re-election and he'll stake it on his no vote for this bill. And the second is Senator Rand Paul, who says that he won't vote for anything that hikes the debt ceiling and he wants to see deeper spending cuts. And that really does illustrate the bind that Senate Majority Leader John Thune has found himself in, because there is broad agreement about those core pillars of this package when it comes to immigration priorities, defense priorities, and of course the tax cuts, but they are really divided on the spending cuts. So there's a few different members that we're watching for here. One are those Republicans that have been pitching themselves as fiscal hawks. Take Senator Rick Scott, for example, Senator Ron Johnson. Now, we do have reports that they do both appear to be, at least Ron Johnson, on board with this bill. We're watching Rick Scott closely because he had proposed an amendment that would have made steeper changes to Medicaid when it came to rolling back Medicaid expansion under the Affordable Care Act. And they actually decided not to even vote on that amendment. That was part of getting his vote on the original procedural steps to advance this legislation, was a promise by the majority leader that Rick Scott could put his amendment up on the floor, and they ended up pulling it. So I would say that he's a really critical vote to watch here, and perhaps wasn't too happy that his amendment didn't end up getting a vote, and he could potentially be teetering here. Some other of those fiscal hawks that we've been watching closely, Mike Lee of Utah, Cynthia Lummis of Wyoming, and then on the moderate side, it's the 2 senators that we often point to, Susan Collins of Maine and Lisa Murkowski of Alaska. We know that they have really been a focus of these efforts to try to bring them to the table. For example, Lisa Murkowski got a vote on one of her amendments. It did fail, but she had proposed hiking taxes on the wealthiest Americans that make more than $25 million a year in exchange for more funds for the Rural Hospital Fund. That amendment ended up failing.
All right, Tyler, appreciate the update. That is Bloomberg's Tyler Kendall joining us from Washington, and we'll continue to monitor that Senate vote. Of course, it has its critics outside of Congress as well. One, Elon Musk, and that's a big reason why you have Tesla shares down about 4%.
He makes more than $25 million.
He certainly does.
Or, I don't know, I guess it depends which year, right?
Yeah, and a lot of that is mostly tied up in
It's amazing
stock.
that the Democrats voted against that amendment, because you would think they want to hike taxes on those making that much. Coming up, Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets, joins us. This is Open Interest. All right, we are continuing to monitor the GOP tax bill. One big, beautiful bill as it moves closer to the finish line in the Senate. Of course, it then has to go back to the House, and we already know there are some people there who aren't particularly enthusiastic about voting for it. But we've got it all for you. Meanwhile, over in Sintra, Portugal, Fed Chair Jerome Powell and his global counterparts are discussing monetary policy with Bloomberg's Francine Lacqua. Powell says he expects the impact of tariffs to show up in inflation data in the coming months, while acknowledging that uncertainties remain. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. So, Mike, is this data that we are going to start seeing, I guess, next week, going to be the data that is finally affected by tariffs?
Well, Jay Powell was sort of asked that question when he was asked if he was in favor of a July rate cut, like Chris Waller and Mickey Bowman. And he said it's too early to say whether we should do a rate cut in July or not. And that was kind of basically the view of all of the central bankers on the stage. They don't know what they're going to do next. And all of them basically put some or most of the blame on the United States, the Trump administration, for the uncertainties that tariffs and taxes are causing. They don't necessarily agree on the impacts. The governor of the Bank of Korea saying it might be disinflationary, Andrew Powell saying it might, or Andrew Bailey rather saying it might be inflationary, and Jay Powell saying we just don't know. We have to keep watching. A couple of interesting notes, though, from Powell. He was asked about whether or not he is going to stay on as a bank governor even after his term as chair runs out. And he said, again, I have nothing for you on that today, keeping maybe a little leverage over the administration. And he was asked what keeps him up at night. And he said, I just have 10 months left to go. I want to turn over a good economy to my successor. And what keeps me up at night is how we're going to accomplish that.
Yeah, he made it pretty clear that he just wants to do his job. He wants to focus on doing his job, I believe. That was the sort of language that he used.
And always does.
And always
it's like
does.
Never changes,
but now we have different inputs. Now we have, of course, political pressure, as well as the fact that we aren't necessarily seeing that inflationary impulse coming from tariffs. And he did acknowledge that the Fed likely would have cut by now had it not been for tariffs.
Yeah, basically he was repeating the things he has said before, and he and other Fed officials have said they would have cut if not for tariffs or the uncertainty over tariffs. Now, as to whether we're going to see inflation, we did get the latest ISM manufacturing numbers out while they were talking, and the prices paid number went up again to 69.7 from 69.4. Not a huge increase, but it is an increase. What's interesting in these numbers, besides the fact that the PMI went up a little bit to 49, still under 50, but production rose over 50 to 50.3. New orders fell to 46.4. So it's a good news, bad news, mixed report. But here's the interesting thing. The number of imports rose. That's not something people were expecting. 47.4, still below, but the 50 level, but it is an improvement. Also got the JOLTS report. And this is kind of interesting with jobs coming up. Job openings rose significantly, more than 300,000. The quits rate rose to 2.1%. So if you're asking if the labor market is falling off a cliff and the Fed has to react, these numbers, while they're a month old, don't suggest that in any way.
I think it's interesting that you might see the effects of Trump policies on two fronts. Right? On the one hand, labor supply. It's got to be getting tighter and tighter because we have no one else coming across the border, and we're sending all of the undocumented immigrants to Alligator Alley now or whatever. So, and on the other hand, we're finally going to start seeing the effect of tariffs on auto sales, right? We haven't seen monthly numbers yet. Ford put out second quarter numbers that were actually higher, but we did see J.D. Power say they think the SAR, the seasonally adjusted annual run rate, is going to fall to 15 million from 17.6 as tariffs finally start to hit those vehicles on the lots.
Yeah, it has started to hit. Last month, we saw a decline in the seasonally adjusted selling rate, and the expectation is it will continue to go down because people don't want to pay so much, which is why we saw a big move pushing car sales into the first months of the year as people try to avoid tariffs. Now, maybe if the Senate moves on this today, we'll get a little bit more clarity on what's going to happen on the revenue side, on the budget side, the tax side. But all of the members on the stage there were saying we need more information from the United States to know how it's going to affect our economy. And I have to give Francine Lacqua credit for what was ironically the funniest question of the day. As this is Senate stuff's going on in the background to their discussion, she said to Jay Powell, last year, you said that the U.S. fiscal situation was unsustainable and we need to do something about it as quickly as possible. How's that going? And obviously not going well at this point. He repeated the same advice.
Well, we'll see how things turn out with this big, beautiful bill. Bloomberg's Michael McKee there talking to us about the economy and that panel we brought you from Sintra. You can follow that. Continue to watch that by typing Live Go on your Bloomberg terminal. Joining us now to talk more about the markets is Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. And Amy, it looks like we're seeing more bullish investors, maybe retail investors over the last week buying options. Are you concerned about a melt-up? Because we've heard that from a few guests today.
Yeah, they can't stop, won't stop. And the issue is if they don't stop, then, at some point, I think the institutional investor community has to jump into the pool. That certainly has been the refrain sort of in this post-COVID regime. We've seen that over and over. And I will tell you right now in the short term, I think that still continues to be that risk, that right tail risk. Even though further down the line, call it 6 months out, we do see concern in the derivatives market.
That's really interesting that, short term, the next couple of weeks, next few months, it seems like things are pretty sanguine, but you're seeing some concern when you zoom out the timeline there, Amy. Does that make sense to you?
Yeah, and what I'll tell you, Katie, is that has not changed at all. We kind of saw that when we hit the low during Liberation Day. And I watched that really carefully, just that options term structure, because I thought, as we continue to rally post-Liberation Day, that would start to move. And it hasn't. And it just tells me that I think a lot of investors basically believe we're going to hit that inflection point, be it when the Fed has to make a move, or you see that translation into tariff impact or the hard data. It just keeps getting pushed out. I don't know how else to explain it other than that, because you've seen this very sticky skew, that demand for downside protection really not budge kind of T plus 6 months out. And yet, here we are at max exuberance here. I think that's your sign that there's still a volatility pothole ahead. But as usual with timing, it is very difficult to say when outside the kind of approximate 6-month bucket.
What can you divine, Amy, about the course ahead for the dollar after it's taken such a beating over the last 4 or 5 months? What does it look like going forward? Could we see another 10% decline?
Yeah, it's interesting because I was just reading the notes this morning from our head of FX strategy, who had been on the road seeing clients, essentially asking that question. And it sounds like the answer is it's pretty divided. So you have folks who think that, this is where we are, and others who think there's a ways to go. It's interesting because I'll tell you, when I speak with investors, probably more in, call it the fast money community, they always conflate this issue with the issue of Mag 7. So the question being, when you think about the US dollar, you also kind of end up thinking about a flight to safety into that Mag 7. And I would say a lot of those folks remain sanguine that, because AI is such a secular theme, you're still going to continue to see rotation there. Like the blip we saw where we thought U.S. exceptionalism was over was merely that. It was merely a blip. And I would say that the sentiment continues to be that this is something, especially if you think about the retail positioning, that continues to carry us forward.
And Amy, I'm also curious to get your thoughts on seasonality, because sell in May certainly did not work this year. But then you take a look at how July typically goes, and it looks like from where I'm sitting that we haven't seen a negative July in the past decade. So how do you weigh some of those seasonal factors and the fact that we are in the summer months now?
Yeah, I think I saw some statistic that July, when you kind of go back decades, is actually the seasonally best performing return month for the S&P 500. And on the mirror side of that, which makes sense, Katie, is that it's also one of the lower realized volatility months. You know, sometimes I like to just go back a year and say, hey, what were we worried about then? If you guys remember, this is when we were worried about Biden stepping back. This is just post the presidential debate, who would even replace him at that point in time. And then basically a month later, you got August 5th, which was the massive vol spike that, you know, was really seemingly triggered by not that much at all. So I would say that while, you know, you always have these historical precedents, as liquidity dries up as you get into July and August, I would be really wary of those potholes, because they tend to be exacerbated by the fact that there also just isn't that much liquidity in these months.
All right, Amy, always good to get an update from you. Appreciate your time. That is Amy Silverman of RBC Capital Markets. I do want to bring you some breaking news now. This from AstraZeneca. According to reporting from The Times, the AstraZeneca CEO has discussed moving its listing to the United States. This is something we've seen more and more in the past couple of years. These European and UK-based companies really moving to U.S. markets, U.S. exchanges. You can see AstraZeneca seeing a little bit of a pop right now, up 3%. Again, this is according to reporting coming from The Times, but typically what we hear is that basically you can get a higher premium, a higher multiple in the United States than maybe you can in some of those overseas exchanges.
That's right. I'm looking at AstraZeneca right now. You can see the intraday trade is up almost 3%. But if you look year to date, the total return has been a drop, negative 3%, negative 3 1/3. Of course, that looks better, right, when you are a dollar investor, because you're getting it in pence there. But it still doesn't look fantastic for that stock. Let's get some of the other single stocks moving at this hour. For that, we go to Bloomberg's cross-asset reporter, Isabel Lee. She's with us here on set. Isabel, what are you watching?
First is Tesla. Shares fell 7.1% in the open. That's the lowest since June 5. But now they pared back some of those losses, but still down by 5%. So lots of headlines this morning. And to sum it up, it's really, again, a feud between President Donald Trump and Elon Musk. So we have Trump threatening to withdraw government subsidies from Elon Musk's company. This comes after Musk criticized Trump's tax bill and spending bill. So Musk has pitched a cost-cutting effort during the campaign, but Trump says he may now turn it back against Musk, saying that Musk is the biggest beneficiary in anyone in history. And get this, Trump also said he will examine Musk's immigration status. So Elon Musk was born in South Africa and now holds U.S. citizenship. And in the midst of all this, we have Musk taking over sales in Europe and the U.S. following the high-profile departure of Omid Afshar. So the stock is set to extend its 5-day losing streak to a 6th straight session. That's the longest stretch since February. So lots of stuff happening to Tesla.
Absolutely. Down almost 30% year to date on Tesla shares. It's been stunning to watch. But what's going on with Nike?
Nike is seeing a pop. It's up 3.5%. We like shoes in this program. So we have Argus Research upgrading the company to a buy, saying that a recovery is underway. So they really credit the products up to date of Nike, saying that because of their clearing of the inventory in the second half of the year, it's really attracting a lot of customers. And other positives is really Nike utilizing its e-commerce. So you see shares there edging higher. The price target is now at $85 by Argus Research.
Have you seen the Snowfers?
Oh, God.
I've heard of it, but I haven't seen it. Maybe for the better.
Yeah, they may be good for you. They're good, apparently, for people with sensitive feet. So check out those. Isabel Lee, thanks very much for joining us on that. We're going to continue, Katie, to monitor, obviously, what's going on in the vote-a-rama, which is now, what? It's been 25 hours, almost 26.
25 and counting, moving closer to a final vote. You can see people milling around on the floor. We'll continue to monitor that. And coming up next, Apple is considering using AI technology from other companies to help power a new version of Siri. We'll bring you the details of that scoop up next. This is Open Interest. Welcome back to Open Interest. Let's go back to that Bloomberg scoop that Apple is considering using artificial intelligence from Anthropic or OpenAI to power a new version of Siri, potentially sidelining its own in-house models. Let's discuss with Mandeep Singh. He is Bloomberg Intelligence Global Head of Technology Research. And Mandeep, just put this into context to us, because you're not seeing too much reaction in the stock necessarily on today, but this seems like pretty big news.
It is, and look, when it comes to LLMs, now there is a point where everyone wants to think about LLMs on the device, how they can use it for their own data, whether it's your emails, your contact information, the documents that you have on your phone, and really have it work as a super assistant. So I know the focus is on Siri and how Apple can use one of these LLMs to enhance Siri. I think it's more for their overall App Store revenue. Because think about what an AI agent is doing. It's actually consolidating the functionality of all the apps and having you interact with different apps without actually going inside each app. So from that perspective, if they don't have a good LLM to complement their App Store, then they could lose a lot of that App Store revenue down the line. So I think it makes sense that they are doing it now and using a third party. And Anthropic makes a lot of sense to me because they are focused on
Anthropic, right? Although OpenAI is working with Johnny Ive to create the iPhone killer.
But that's where the conflict is, right?
Yeah.
So why wouldn't Apple use OpenAI given the conflict
I
over
want to
there?
ask, there's a million questions. We've been talking about this a lot and we'll continue to. You know, why isn't Siri good enough already? This company is like the smartest in the world. But my main question about AI, because I use it a lot, is when is it going to be able to go into other apps for me? When am I going to be able to get ChatGPT or Siri or Gemini or whatever to go and look into autotrader.com or to go into my Bloomberg terminal and do stuff for me? Be truly agentic.
We're talking weeks or months here, so it's very near term. That's really the vision when it comes to the agentic functionality. Exactly. I mean, all these companies will be forced to expose their APIs. You don't want consumers to be going into apps and, doing the mundane clicks. The AI agent, the super assistant, should be able to do that. And that's the vision. And I don't think it's that far-fetched. It will likely happen this year. We're talking probably third quarter.
That's very exciting.
Weeks or months, absolutely. The future is coming fast.
It's coming.
Mandeep, always great to see you. That is Mandeep Singh of Bloomberg Intelligence. Now, coming up, President Trump's big, beautiful bill is heading closer to the finish line in the Senate. We'll head down to Washington next. This is Open Interest.
All right, in just about 10 minutes, it's going to have been 26 hours of negotiations in the Senate. They've been there all night long, just knocking back coffee and donuts. Republican leaders believe they now have the votes to pass President Trump's $3.3 trillion big, beautiful bill. Joining us now is Bloomberg Balance of Power co-host Kayleigh Lines. Kayleigh, as we understand it, they can't afford to lose more than 3 votes, right? And they already have 2 that are definite no's, 2 Republicans that are out. So are they going to get there?
Well, the majority leader, John Thune, has suggested he does think they can indeed get there. But you're right, Matt. Rand Paul, the senator who refuses to vote for this bill over a debt ceiling hike, is a firm no, as is Senator Tom Tillis of North Carolina, who just announced that he is not seeking re-election. That means that there's really only one more they can afford to lose. And a lot of leadership's attention has been on Senator Lisa Murkowski of Alaska. It's unclear what kind of deal may have been made at this time in order to win over her vote or the vote of Susan Collins of Maine, who also has said she has reservations about this legislation. That said, we are seeing some optimism expressed by leadership on the Senate floor. Right now, as we speak, the Senate parliamentarian and staff are actually looking through a revised version of the bill. The red line version is in front of her, keeping in mind that before they can actually get to a vote on final passage, they're going to have to vote on a so-called wraparound amendment that will make all these tweaks to the legislation, also potentially changing the language within it to strip out parts that are particularly objectionable to the House of Representatives, which will, assuming that final passage passage in the Senate can be secured, get this bill back. And if they want to avoid going to a conference committee, well, they will extend this process, having to negotiate back and forth between both chambers, have to pass it as is if they want to get this to the president's desk by the self-imposed deadline of July 4th. So depending on what happens in the next hour or so here, we'll see how realistic that deadline really is.
And speaking of the president, President Trump says, I hear we're doing well, specifically on the tax bill. But let's talk a little bit about that language for the House, because you remember the House's own version of the bill passed by a single vote. So in both chambers, we're talking about very razor-thin margins here.
Yeah, we absolutely are. And there's going to be some difficulty in the House as there's different elements of the Republican conference that want different things. It does seem that at least the vast majority of the so-called SALT caucus has been pacified by a deal struck with the Senate. Changes in this language that would include that $40,000 cap for those making up to $500,000 for 5 years. Nick LaLota, the congressman from New York, has suggested that's not enough for him. But putting that one vote aside, it does seem at least that wing may be satisfied for now. Then there is, though, still a problem with fiscal conservatives in the House who do not like that the Senate version of this bill is likely to expand the deficit even more than the House version. According to the Congressional Budget Office, this would cost about $3.3 trillion compared to $2.8 trillion for the version the House passed. Yes, they're trying to use some different accounting measures with the current policy baseline to take that number down, at least on paper, but it's still going to be hard for a lot of those House Freedom Caucus members to swallow. So that's who we're going to really be focused on, assuming, again, that this actually can get to the House. It still has to finish the uphill climb in the Senate first here.
All right, Kayleigh, thanks so much for that roundup. Kayleigh Lines there, co-anchor of Balance of Power. You can catch her on Bloomberg Television and Radio at 1 p.m. and then again at 5 p.m. Eastern. I'm sure they'll have a lot to say as well about the renewed spat between President Trump and Tesla CEO Elon Musk. It's so fascinating to me because somebody like Joni Ernst, who is concerned about the phase out of credits for solar and wind, if she's worried about getting primaried by Trump, maybe if she has Elon Musk on her side, that gives her a little bit more courage.
That's true. We'll have to see how it all shakes out. We'll have coverage throughout the day. This was Open Interest. We'll see you tomorrow.